Hello, you're watching The Pitch. I'm Sarah Allen. Traditional views around asset allocation are evolving. It's time to rethink what you know. To better explain what the new norms around asset allocation are, I'm joined by MLC Asset Management's Anthony Golowenko. Anthony, welcome.
Great to be here, Sarah.
So to begin with, what are investors getting wrong when it comes to asset allocation?
I think in a nutshell, the three things: adopting a traditional approach with traditional indices and a traditional mindset. And we think delving a bit more deeply into asset class and sub-asset classes, rewriting some of those rules can lead to superior outcomes. But ultimately investing, if you think about, it's fairly inherently simple. We're deploying capital at some level of risk for an expected outcome over an appropriate time horizon at what should be an appropriate fee level. And it's just those combination of things together that come to constructing those portfolios.
What should optimal modern asset allocation look like compared to the past?
I think where and how things are built traditionally, let's go back 25 years. So you might have residential property, term deposits and Australian shares. Now that's done quite a good job at delivering for investors. Where we are now and the breadth and full continuum of opportunities, we think there's a lot more to be done and more asset allocation levers to pull by delving a bit more deeply into those asset classes. Perhaps Australian equities, what are largely income orientated with franking credits, homogenous lending machines in our major banks, that's a growth asset class. And something, sub-asset class approach like smaller companies would be more growth orientated, and into mid-caps, which might be a balance between the two. So stepping away from that, thinking more about what the role is and purpose and how that contributes, we think about that as our approach.
What typical ranges for asset allocation might you see in a balanced portfolio today?
For ranges and what we'd be looking for, we have within our managed account strategies a conservative 30, moderate 50, balanced 70, growth 85, high growth 98. So conceptually we could swing those by up to 20%. And in extreme cases, more on the risk side of things, we would be in a position to do so. In practice, with an investment committee governance, that range is more like plus or minus 10%. So that's at an asset class and sub-asset class level. And why do we have those ranges? It's kind of somewhat obvious. We have those to allow investment views at asset class and sub-asset class level to be imparted in the portfolio. So give that flexibility for active management. We're strong advocates of that.
How frequently should investors be thinking about rebalancing or adjusting their asset allocation?
I think at the high level, those big sort of punchy AA calls and changes, we've been running now in our managed accounts program for probably coming up on 4 years. And we would expect those sorts of wholesale changes every 2 to 3 years. It's got to be around something major or things unfolding. For us, we were thinking about our short maturities within fixed income, allocating that to all maturities, building out credit and getting a bit more resilience with some global equities to emerging markets, and also building out some flexibility in our real return components of the portfolios, including alternatives. So I'd say every probably 2 to 3 years for those big calls, refinements perhaps 2 or 3 a year, and then from a hygiene or discipline side of things, where you are getting that natural drift or deviations, pushing out to, for our portfolios, we're monitoring from 2%, but at a 3% level, start to bring it back to an inner band. So those sort of rules of thumb around asset allocation ranges. You want the flexibility, but at the same time, you don't want to be over at the controls, madly tinkering with portfolios. We want to be try and be parsimonious.
What 3 rules of thumb would you recommend investors use when it comes to asset allocation?
I think being really clear, what is your investment thesis or rationale? Write it down ideally and periodically go and revisit it. Within that, the second point, thinking about the potential upside but also downside risks, and to my kind of earlier sort of comments around this distribution of potential outcomes that in theory and in practice are actually going to be quite wide. And the third one is adopting a continuum or full spectrum thinking around asset classes. We've got this whole world of opportunities. Go out there and grab them.
Thank you so much for sharing your insights today.
Thank you.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.